just wanted to kind of go over things that have happened in November, give you a little bit of insight on the market, what we're thinking, some things that are happening right now and how that may impact portfolios, and answer any questions that you may have. Yeah, Nora, let me see if I can help you. Cool. You should be able to share now, Nora.
Try. All right. For some reason, it's not letting me to share, but that's okay. Just saying that it's been stopped. But yeah, so Sean had mentioned a couple questions came in, and what we kind of want to do monthly is just give you our thoughts on what happened the previous month. So we're looking at November, and maybe some expectations as we move forward. Again, just educational. So if you have any questions, continue to send those in, and we'll just save those for the next monthly live webinar. So Sean, real quick before we get into some of the questions, we did hold a webinar kind of mid-November talking about the second lockdown and preparing your portfolio. Can you share some key takeaways that for those that weren't able to attend that webinar, just kind of what we learned from the first lockdown and how we can prepare for the second?
Yeah, so kind of our talking points there were, during the webinar or during the pandemic, as we're going through it, we were educating, saying, hey, you need to stay disciplined, stay in the portfolio, don't panic and sell, because most people were, right? We saw a lot of money move into US Treasuries. We saw stocks plummet. We saw bonds fall because some companies that used to have really high credit ratings, we used, Delta Airlines, for example, record-setting profit year, and then 1 month later, having to issue really, really high credit, high yield, I should say, bonds, so bond prices started to fall because they were no longer as reputable a firm, because there was kind of uncertainty in terms of their future outlook. And so our message was stay the course. It's going to come back quicker than you think. Traditionally, it always has. We've been through pandemics before. And when they do come back, they come back fairly strong. And so, that's exactly what happened. Since, kind of the downfall of the market was on March 24th. And since then, the market has come roaring back. And so as we get into this potentially second lockdown, depending on what state you're in, depending on kind of what happens in terms of the political environment, there may be a second lockdown. And so we want to stay the course again. And kind of one of the big points that we mentioned was we learned as well. US Treasuries were a safe place to put money. So we've done some rebalancing the portfolios to add more US Treasuries, kind of some intermediate term government bonds, because people tend to run to what's safe, and the government bonds tend to be what's safe. And so we saw those actually up through the pandemic, through April timeframe, up more than 7 or 8%. And so we rebalanced and put some more of that in the portfolio just in case we do get another lockdown here, end of 2020, early 2021. But ultimately, we want to stay the course. And we know more information now, right? We kind of understand that a vaccine is possible, could be imminent. They rolled it out in Europe just today. Russia and China have been given the vaccine since last week, and potentially as early as Thursday here in the US. So we didn't know that back in March, so we don't anticipate a 30 to 40% drop like we saw. We just feel like there's a little bit more certainty this time since we've been through it before. Also, we saw a $2 trillion stimulus package, money in people's hands in record-setting time, and that kind of helped us come out of it. And so we know that those measures will work, or at least help a little bit. And so we'd anticipate more stimulus, more relief should we enter a kind of a second coronavirus lockdown. So that was really kind of a recap of what we talked about. Stay the course, stay invested. We know more information now than we did in the past. So if we do see a second lockdown, we anticipate to not be as bad, but we've rebalanced in the portfolios and added some more government treasuries so that should we have a lockdown, that we would have a position that would remain very stable.
Yeah, and John, I think one key takeaway that I had, that I know some people on the webinar had, is like John mentioned, just stay the course, especially if you hear, friends or like colleagues on, your webinar, Zoom meetings that you have at work from working remote, when they say like stop contributing to your 401k or sell to cash, one thing, key takeaway is if you are hearing those things and you have some hesitancy, just reach out to us, but certainly just know that you're in the portfolio that's built right for you specifically. So that was one key takeaway. And we got a lot of good feedback from that webinar. So another question we have, and luckily we're kind of over the hump there, but let's lean a little bit more towards politics, Sean. It appears that President-elect Joe Biden is going to be our next president. Although the markets didn't seem to have a problem with that thus far, we are still waiting on the Senate control. Who's going to control the Senate? What kind of impact may that have? And what does that really mean?
Yeah, so we did a webinar in October kind of talking about the election and kind of how that can create some uncertainty in the market. But ultimately, after we get results, whatever they may be, we really get a lot of certainty, and the markets like certainty. And so markets historically after an election, other than having a black swan event like a terrorist attack, coronavirus, right, something like that, markets tend to perform pretty well after a president is elected. And so we create, and the media creates, because that's how media makes money, right? They sell advertising, they create fear. The media makes money and they stoke fear in us, but generally speaking, the markets don't really care, right? They like certainty and they like to be able to predict. So once they understand who the president's going to be, what the makeup of Congress will be, they're able to make better projections and kind of predict the future a little bit better. And so markets like that stability. So as we get more and more information, we anticipate more certainty in the markets that have continue to have some strong growth. That being said, right, depending on the president end results, they look like they're pretty much done, or depending on how Congress shapes up here coming into the early 2021, we do anticipate some changes to taxes, right? So no matter who's elected, right, we're putting $2 trillion in the economy. We're talking about another $900 billion right now as stimulus. There will be taxes. There'll be changes to the tax law. That's a constant thing. And so things that we can do is do the best we possibly can, given the known information, to develop the best tax strategy. And so a lot of the things that have come out with the CARES Act and just kind of the changes, the overall tax laws will impact portfolios. And so that's a very, very big benefit of meeting regularly with your advisor, talking about how does this impact you? How can we make the best moves given the political environment, given the tax environment, as you approach retirement, as you get into retirement, so that you can maximize your wealth.
And John, a follow-up question to that, and you kind of mentioned there, is there so much noise in the media? They harp on creating fear, and that's kind of what we hear in the forefront. So can you just give us a general understanding of how the markets are really performing? How did they perform in November? How are they performing year to date?
Yeah, so probably contrary to most belief, I think, and I said this back in March, I said it was possible, and now it's inevitable. But I said we may look back in a year like 2020 and say, what was so bad about 2020? We look at the markets and they were up. I was thinking single digits, but so far, right, the markets, the S&P 500 is up about 15% for the year to date. And then NASDAQ's up almost 40% year to date. So the U.S. economy, the markets are really, really strong. So if you would have said to someone back in, mid-March that we would be up 15% for the year, no one would have believed you. No one predicted that. I don't care how much experience they have. Warren Buffett didn't make those projections. People on Wall Street don't make those projections. We certainly didn't. But we did stay the course. We believe it could be positive, and it's exceeded our expectations. And a lot of that's because of the political environment, some things we did, and employers kind of adapting. But the market as a whole has been up a lot this year, a lot more than people anticipated. And so, again, a lot of reason to stay the course. In November, right? So for the people, your friends, colleagues, coworkers, Uncle Rico, we talk about at Thanksgiving dinner, people that stopped contributing to their 401ks or got out of the market. The S&P 500 was up about 11%, 10.95%, I think it was, in November. So if you pulled out of the market and tried to time the market, you just missed one of the greatest months in the history of the market. And so that's one reason we don't time the market, because no one knows, no one can predict. So the best thing to do is be in a portfolio that's built for your comfort for risk and stay the course. And those people that are trying to time the market, they're gambling, right? They're gambling with their retirement savings, they're gambling with their life earnings, and it's not a good strategy. And so one of the things that we try to do is create that peace of mind by building a portfolio for you so that you can stay the course and have months like November where it's up almost 11%.
Nice. So don't listen to Uncle Rico at Thanksgiving and don't listen to him at Christmas.
Right. Yeah. As Christmas is coming up, right? Everyone's be talking about their Tesla or whatever it is. Just know that anytime someone gives you their winner, right, they've got 5 or 6 losers, right? The data is pretty overwhelming. Timing the market, trying to pick individual stocks is a loser's game. And long term, it's nearly impossible.
Yeah. So Sean, the stimulus bill, we took some takeaways from the first stimulus bill on the first lockdown. Any thoughts on like where we are with the stimulus bill? Is it one coming? What's the status of that?
Yeah, so kind of some recent things that have come out, right? So is that we've kind of got some bipartisan support. So previous to the election, they were talking about the Democrats were looking for 2.2 trillion. Trump and the Republicans said, hey, maybe 1.8 trillion. And now that we've kind of progressed and there has been no progress, now people are saying, hey, this is legitimate. We need a relief bill. And so now they're on the talks of around $980 billion being pumped into the economy, just for kind of some situational awareness. We did the 2008, rather than the markets crashed due to the banks and the housing mortgage crisis, pumped about $800 billion. So still even more than that we'd be putting into the economy in our second round of relief. So a huge package still be coming forth. A lot of it focused on local governments, right? Whether you know or not, right? Employers aren't having to pay certain taxes, kind of relieve some of the income tax within states. And so now those states are not furloughing people. They're not laying people off like small businesses are. So they still have bills to pay. So about 160 billion of that would go towards kind of local and state governments. And then we have another round of PPP, Paycheck Protection Program for some small businesses. A lot of that bill didn't even get used. They set aside in that 2.2 trillion. They set aside a big chunk for the small businesses that didn't even get used up. So a lot of that will be rolled over to this relief bill. And so kind of some different areas, but right now it looks like it's going to get a lot of support, kind of bipartisan support. Even Joe Biden said we got to get something done. We need a deal done. We just had a November jobs report, which was not great. We've had some strong job growth leading up to November, and it kind of had a pullback. So I think there's a lot of pressure right now to get something done and get it out there. They're voting, or at least having discussions continued this week. We may see something as early this week in terms of, hey, this is going to get approved. So if we do see that, we could see kind of a boost in the economy again. Markets continue to get a short-term boost from that. Long-term, so much uncertainty of how that will predict. We've just never done this kind of economic relief before. I know I kind of go back and reading some work from like Ray Dalio and saying the last time we kind of pushed this much stimulus in the economy was post World War II, and we saw some serious high inflation rates, double-digit inflation. That could be on the long-term outlook. So those are kind of some of the macroeconomic effects that we'll be monitoring over the upcoming years.
So Sean, I just know with some of the conversations we've had with clients this quarter, as well as some prospects coming up, you mentioned the trade or the stimulus bill pumping money into the economy and the impact on inflation. Can you talk a little bit about some of the conversations that we've had where we have people that just have money sitting in their savings account, and what does inflation mean to that chunk of money just sitting there?
Yeah, so it's kind of key to define inflation. So inflation is the general rise in the price of all goods. So when we talk about certain things, right now, we talk to clients, we've got clients all over the country, and every single person is talking about their house right now. People's homes are appreciating like crazy. The market's red hot. It's not just in Columbus, Ohio. It's not just in, Florida, right? Everyone is making money on their house right now. And so that would be considered something like cost growth, right? So that's not necessarily inflation, but it could be a precursor to inflation, right? So interest rates are extremely low. We've seen clients get 2.5 to 2.7 for a 30-year fixed mortgage, just ridiculous interest rates. So people are able to afford more house than maybe they were in the past. and now the price of homes are rising, right? So we call that cost growth. Inside of there, right, we've got something we call inflation. And a part of cost growth is inflation. And what that does is it erodes your purchasing power. So if I have $100,000 sitting in cash in my savings account or in like a bank CD or a money market account, earning 0.5% or 1%, well, what we saw post World War II, what we saw in the 70s, right, we saw double-digit inflation. And what that does is if you're only earning 0.5% or 1% on your cash, and all of a sudden we get a 10% inflation number, you just lost 10%. So oftentimes people think if I have a whole bunch of money in cash, that's the safest place for money. And I'd argue it's actually the riskiest place for money because it's a guaranteed loss. So what we do with our clients is we always want to have some just kind of cash flow for monthly purposes on hand. So we always recommend like $10,000 in a savings account. Other than that, you want your money in a very conservative account. We try and target like a 3 to 5% growth, 30% equity, 70% fixed income. And what we do is we have that money grow. So as inflation rises, your conservative portfolio rises, your cash, if you will. Still extremely liquid, but it's going to grow as your wages grow, right? Your emergency fund grows. As the cost of a home grows, right? Your conservative account grows. That way, if you need your next home, you have a down payment. If you need to make changes to your home, right, you can make those with that emergency fund. So one of the riskiest places, and the key takeaway is if you have a lot of money sitting in cash, it's actually the riskiest place for money, right? You want to get that money working to you. You just need it working for you in a very safe way.
And as we kind of wrap up on this 15, 20-minute limit, Sean, going back to our first question on key takeaways from our webinar on the second lockdown and what we learned from the first, some key terms that we hear the media talking about is the trade deficit being its highest level in 14 years. Talking about our portfolio or people that just have U.S. stocks and bonds in their portfolio, what makes our portfolio different when it comes to, for example, a U.S. trade deficit?
Yeah, so kind of the U.S. trade deficit, what that really means is we could have some slow economic growth. And one of the things that we see as we put $2 trillion and potentially another $900 billion into the economy is the dollar has been absolutely crushed. Okay. And so our dollar buys less goods overseas. So before, for example, maybe you could buy a candy bar in Europe for $1. Now, right, that's 60 cents. Your dollar's only worth about 60 cents. You're going to need 2 of your dollars to buy a candy bar over in Europe. Now, that's obviously an exaggeration, but that's kind of what that means. So we need more of our dollars to buy international goods. And so we have to spend more money to buy those products, which means international value tends to go up. So one of the things that we see in a lot of people's portfolios is this home field bias, right? So people just invest in the US economy. They have money just in the S&P 500. And so one of the reasons that that's not a great strategy, right? Just to take a look at the NASDAQ versus the S&P 500, one of the ways that we're different is we have a NASDAQ index in our portfolio. The NASDAQ's up 40% this year, while the S&P is only up 15%. That's a huge boost, right? So having that diversification is very, very clutch. Another kind of value add, right, is international. So we take an international position that's based on the world market capitalization of international stocks. That's a nerdy way of saying based on the price of kind of all businesses, our portfolio is weighted towards international, which turns out to be between 40 to 50%, in a given year. So where that provides value, right, is in early 2000, people can remember, right, we had this huge tech bubble bursting. And we saw the U.S. economy and then we got hit with 2008 and then 9/11. So the U.S. economy was flat for 10 years. The S&P 500 was flat. We called it a dead decade from 2000 to 2010-ish, right? So international during that time period was actually crushing U.S. performance. If we go back and look, 50, 60, 70 years, and you look at international compared to U.S. over a long period of time, they both do about the same. And so right now, over the last 10 years, we've seen U.S. stocks do really well, international not so well. We could be in a moment where that starts to reverse course. The dollar has been crushed. International has not put as much stimulus in the economy. So maybe they're their underlying principle, their foundation is a little bit stronger. It's not as weak. And so when we do kind of get a full recovery, they'll bounce back a little bit quicker and stronger. And so we're not predicting that. We don't know if that will happen, but the power of diversification, the power of having international in your portfolio, NASDAQ, S&P, US small value, international small value, emerging markets are having a phenomenal year coming out of that March low. Having all of those positions in your portfolio allows for a little bit of fluctuation, but a much steadier climb throughout the road. And so that's the way that we provide value, by putting the right blend of all the different asset classes in the portfolio and without trying to time the market. We don't try and bet on the NASDAQ or the S&P 500, because what people tend to do is, and this is, Tesla is a great example of this, right? Is as, right, companies do really well, everyone knows that they should sell high and buy low. But I can't tell you how many people recently have been telling me, like, hey, I think I want to buy Tesla. And I'm like, you're late to the party, right? And so now if you want to pour money into the NASDAQ or pour money in the S&P 500, you may be late to the party. And so we don't try and do that. We try to provide a world market capitalization, diversification structure, and we stay the course. And then as positions are discounted, we want to buy those. And so we always want to buy low and sell high. And so one of the ways that we provide the value is just adding all of that diversification. We have over 18,000 different stocks and bonds in our portfolio, so that you can have peace of mind with your portfolio that it's going to stay the course.
All right, well, I appreciate everyone's time. I appreciate all the questions. There were some great questions that came in last month. If you continue to have some questions, just feel free to either message us. I know Sean's going, I think, live on Facebook. You can send him a message there. Shoot us an email. We look forward to hearing you. Look forward to having another webinar next month. Again, if you have questions, send us out. Hopefully you found some value in these kind of quick monthly check-ins. Hopefully they raise some questions too that you can either ask your advisor or, again, feel free to reach out to us.
Awesome. Well, thanks for everyone's time. Enjoy the rest of your week.